Welcome back to the Deep Dive, where we unpack complex financial topics. Today, we're getting into something that really sits at the core of protecting your wealth.
Yeah, it's a big one.
We're not talking about protecting your family after you're gone. We're talking about the massive financial threat of surviving.
That's the perfect way to frame it. I mean, everyone plans for the traditional things, right? You have your life insurance, which is for your beneficiaries.
Of course.
And you have disability, which, protects your income if you can't work. Both absolutely essential, no question.
But medical science has created this
Yeah.
new reality. You can have a major heart attack, a stroke, a serious cancer diagnosis,
Mm.
and you live. You survive.
And that's fantastic news, obviously. But
Yeah.
survival kicks off a whole new set of problems. It can be a financial drain that lasts for years, sometimes decades.
So your disability insurance is maybe covering your salary, but it's not designed to stop your life savings, your investments, your retirement funds from just
Yeah.
eroding away.
Exactly. So that's our mission for you today. We want you to get a really solid grasp on the tools designed for this exact problem. We call them living benefits.
Specifically, we're deep diving into critical illness insurance first.
And then we'll connect that to the huge topic of long-term care, which, as we'll see, is becoming more and more critical because of these massive demographic shifts.
Okay, so let's jump right in. Section 1. The unique freedom of critical illness benefits. The core idea seems pretty simple.
It is. At its heart, a CI policy does one thing. You get diagnosed with a covered, life-threatening condition, and it pays you a single tax-free sum of money,
A lump sum.
a lump sum. And that's the key differentiator. Disability is about replacing lost income month by month. CI is about a diagnosis.
And the most important part, I think, is what you can do with that money.
Right. There are absolutely no restrictions.
Done.
Zero. That's the fate of it. It means you can just focus on getting better, on recovering, instead of stressing about which assets you need to sell.
It's like it buys you breathing room. It buys you choice when you feel like you have none.
Think about the costs that nobody ever plans for. It's not just about, topping up your wages.
Right.
You can use that tax-free cash to immediately wipe out your credit card debt, pay down your mortgage. Just imagine the stress that disappears overnight.
And what about treatments? Sometimes the best option isn't covered by the provincial plan.
That's a huge one. Maybe there's an alternative therapy or a new drug that's approved in the U.S. but not here yet. The CI payout lets you make that choice for yourself.
Or even just adapting your life. A severe stroke or an MS diagnosis changes everything.
Totally. You might need to renovate your home. We're talking about ramps, widening doorways for a wheelchair, redoing a bathroom. That costs thousands. And without CI, that's coming straight out of your retirement savings.
And what about work? I mean, after a major health scare, maybe you just can't go back to that high-stress 60-hour-a-week job.
And you shouldn't have to. The CI benefit gives you that cushion. It lets you say, okay, I'm going to switch to part-time, or I'm changing careers entirely. It gives you the financial power to make that transition.
Okay, so this is a powerful tool. Let's move into Section 2 and talk about the mechanics of these policies. How do they actually work?
Well, they first showed up in Canada back in the mid-90s. Standalone contracts offering that lump sum payout we just talked about.
And who can get them? Is there an age limit?
Typically, yeah. For adults, insurers will usually issue policies to people between 18 and 65. Once you get much past 65, it becomes very expensive or just unavailable. There are also some kids plans, but they're a bit more limited.
And the amounts? How much coverage are we talking about?
The range is huge.
Yeah.
You can get a small policy for, say, $10,000, or you could get one for $2 million.
Wow.
But the sweet spot for most people, the amount that really provides meaningful protection for your assets, is usually somewhere between $50,000 and $500,000.
And I assume the amount you can get isn't just a number you pick out of thin air.
No, of course not. The underwriters look at everything: your age, your health, and really importantly, the medical history of your immediate family, your parents, your siblings.
And your finances, too.
Your finances, absolutely. They need to make sure the coverage amount makes sense. It's to avoid what they call over-insurance. The policy is there to protect your assets, so the benefit has to be in line with what you're protecting.
Which brings up a key point for anyone listening. If you have a family history of certain illnesses, getting this coverage when you're young and healthy is crucial.
It's the smartest move you can make. You lock in your insurability and much, much lower premiums.
Okay, so let's talk about the fine print. You mentioned there are 3 crucial timing rules built into these contracts.
Yes, and understanding these is key.
Yep.
They're basically the insurer's defense against what's called anti-selection.
People buying insurance because they already know they're sick.
Exactly. So the first rule is the qualification period. This one's pretty standard. The illness has to be first diagnosed or the symptoms first appear more than 30 days after the policy is issued.
So you can't feel a lump on Monday, buy a policy on Tuesday, and get a diagnosis on Wednesday.
You got it. The second one is related. It's called the exclusionary period.
What's that?
For certain conditions, especially cancer, the insurer might add an extra waiting period. It could be up to 90 days from when the policy starts. It's just a tighter defense, making sure people aren't rushing to get coverage because of a nagging fear.
Okay, that makes sense. And the third rule? You called it the survival or waiting period.
Right. And this goes to the very heart of what CI is. It's a living benefit.
Meaning you have to survive the event?
You have to survive the diagnosis for a set period of time. It's often 30 days. So if, God forbid, someone has a massive heart attack and dies within a week, the CI policy wouldn't pay. The life insurance policy would, but not the CI.
But what if they survive for, say, 35 days and then pass away before the check from the insurance company actually arrives?
Great question. In that case, because they met the condition, they survive the waiting period. The benefit is fully payable to their estate or their beneficiary.
So that 30-day window is the real trick.
That's the threshold. Once you cross it, the claim is valid.
Okay, let's shift to Section 3, defining critical. Not all policies are the same, are they?
Not at all. They're generally tiered based on how many conditions they cover. You have your basic, your expanded, and your comprehensive plans.
Let's start with basic. What are the absolute must-haves?
The big four, as they're often called. That's heart attack, stroke, cancer, and coronary bypass surgery. Almost any policy you find will cover at least those, as they're the most common events.
So when you move up to a plan that covers, say, 10 conditions or even 20, what are you adding?
You're adding protection for things that are maybe not as common, but are absolutely life-altering. A 10-condition plan might add things like blindness, deafness, kidney failure, or multiple sclerosis.
And the really big, comprehensive plans.
Those will start to include chronic degenerative conditions that are incredibly expensive over the long haul. Things like Alzheimer's, Parkinson's disease, or something called loss of independent existence.
So you really need to look at your family history to decide how broad you need to go.
That's exactly it. And this is so important. You have to look past the name of the illness on the list. The specific definition in the contract is everything.
What do you mean?
Well, a policy might say it covers cancer. But if you read the fine print, it will almost always exclude very early stage, non-invasive cancers.
Because they aren't considered life-threatening.
Precisely. The same for a heart attack. It's not just any chest pain. The policy will specify that there must be evidence of heart muscle death measured in a certain way. It has to be severe enough to be considered critical.
So that brings us to a major limitation we need to discuss. CI is usually a one-time deal, right?
Almost always. You make a successful claim, they pay you the lump sum, and the policy is canceled. It's done.
Let's use that Sylvia example. I think it makes it really clear.
Okay, so imagine Sylvia has a policy. In 2020, she's diagnosed with a qualifying cancer, she gets a $100,000 payout, and it's a lifesaver. It lets her pay off her debts and focus on recovery.
But the policy is now terminated.
It's gone. So if 4 years later, in 2024, she has a massive stroke that would have qualified under the old terms, there's nothing to claim on. The contract doesn't exist anymore.
Is there any way to protect against that?
There is, actually. Some policies offer an optional feature called a second event rider. You pay a bit more in premium, and if you have a successful claim, the policy can stay in force to cover a second, completely unrelated critical illness later on.
That sounds like something worth looking into for sure.
Definitely.
All right, Section 4, let's quickly cover some other options and rules. What about riders? The most common one I hear about is return of premium.
Yeah, ROP is very popular. It's a psychological thing, really. People hate the idea of paying for insurance they never use.
So this rider gives you your money back?
Some or all of it, yeah. If you reach the end of the policy term, say at age 75, and you've never made a claim, the insurer refunds the premiums you paid in.
Yeah.
It sort of turns it into a very expensive savings plan.
And the other big one is waiver of premium.
Right. And for this one, we have to be super clear on the definitions.
Okay.
This rider says the insurance company will waive your premiums if you become totally disabled. But the definition of total disability for the waiver is completely different from the definition of critical illness for the main benefit.
So let me get this straight. I could have a car accident, be unable to work for 6 months, and that would trigger the waiver so I don't have to pay my CI premiums.
Exactly.
But the injuries from the car accident would not trigger the big CI lump sum payout itself unless they specifically caused a listed critical condition.
You've got it. The waiver is about your ability to work.
Mm-hmm.
The main benefit is about having a specific catastrophic diagnosis.
Let's talk taxes. The tax-free benefit is a huge selling point.
It's fundamental to how this works. The rules are simple. The premiums you pay for a personal policy are not tax deductible.
Okay.
But any money you receive, whether it's the big lump sum payout from a claim or a refund of premium, is 100% tax-free.
Which is what makes it so powerful for protecting your other assets. You're not losing 30 or 40% of it to the taxman.
Not a dime. As for exclusions, they're pretty much common sense. No payout for things that are self-inflicted or happen while committing a crime, acts of war, that sort of thing.
Right. Okay, so we've established how CI protects you from the initial shock. But survival often leads to a much longer-term need. This brings us to Section 5, the demographic imperative and long-term care.
Yes. Long-term care, or LTC, is insurance for when you can no longer independently look after yourself, the basic activities of daily living.
Like bathing, dressing, eating.
Exactly. And it's not just for the elderly. A young person with a spinal cord injury or someone with MS might need long-term care. But the aging population is where the real pressure is building.
You're talking about the baby boomers.
It's a demographic shift unlike anything we've ever seen in Canada. The number of people over 65 is just exploding, driven by the boomer generation. They make up more than two-thirds of that age group now.
And you had a statistic on this that was just staggering.
It is. For the first time in Canadian history, as of July 1st, 2023, there were officially more people aged 65 and older than there were people younger than 18.
Wow. Just think about that. More seniors than children.
And that inversion raises a massive question. Who is going to pay for the care this huge aging population is going to need? The public system is already strained.
So you have a shrinking base of working-age taxpayers trying to support a rapidly growing population of retirees who need care. The math just doesn't work.
It doesn't. And that's why individual LTC insurance is moving from being a nice-to-have to an essential piece of financial planning. It's about guaranteeing you have access to the care you want, where you want it, without having to sell the family home to pay for it.
So to wrap this all up, it feels like the takeaway is that our definition of protection has to evolve. It's not just about dying anymore.
It's about planning for a long life, even after a serious illness. Critical illness insurance guards your assets against the immediate shock, and long-term care protects them from the slow drain of ongoing needs. They're the guardians of the wealth you spent your entire life building.
That's a great way to put it.
And, just to leave our listeners with a final thought on that idea of planning for the long haul, we talked about Sylvia and how a CI claim usually terminates the policy.
Right. The protection ends just when you might feel most vulnerable.
Exactly. But some policies have a feature we didn't spend much time on, a conversion option. It lets you, at a certain age, like 65, convert your critical illness policy into a long-term care policy, often without any new medical question.
That's interesting.
So a question for you to think about is this. If surviving a major illness is just the first step, how crucial is it to make sure your policy has that conversion feature built in? So you're securing protection, not just for the immediate battle, but for the rest of the journey ahead.